You're 32 years old. That's your biological age. But financially, you're 25. You don't have the savings a 32-year-old should have. You don't have the investments. You don't have the assets. You're 7 years behind where you should be. And here's what's terrifying. That 7-year gap doesn't stay 7 years. It grows. By the time you're 40, you won't be 7 years behind. You'll be 12 years behind. By 50, you'll be 19 years behind. The gap compounds like debt, like interest, like a wound that gets infected because you didn't treat it early. One delayed milestone creates a cascade of delayed milestones. You hit your first $10,000 at 28 instead of 25. A 3-year delay means you hit $50,000 at 35 instead of 31. 4-year delay now. You buy your first property at 38 instead of 33. 5-year delay, you reach financial independence at never instead of 52. Because the gap got so wide you couldn't close it. I call this the 7-year gap formula. It's the mathematical reality of delayed financial progress. For every year you delay a major financial milestone, you lose 1.4 years of compound progress. A 3-year delay becomes a 4-year delay. A 5-year delay becomes a 7-year delay. Most people are 5 to 10 years behind their financial age, and they have no idea, because they're comparing themselves to other people who are also behind. Everyone around you is delayed, so delayed feels normal, but normal doesn't mean safe. It means you're all falling behind together. And by the time you realize how far behind you are, the gap is so wide that catching up feels impossible. But once you understand the 7-year gap formula, you can calculate exactly how behind you are and exactly what it will cost you. My name is Alex, and this is Milestone Money. If you want to understand the real math behind financial timing, hit subscribe. Because being late to financial milestones isn't like being late to a meeting. You don't just miss the start, you miss the entire compounding effect that follows. Here's what traditional finance tells you. It's never too late to start. Just begin where you are. Focus on progress, not perfection. That advice makes you feel good. It's also mathematically ignorant because it ignores the most powerful force in wealth building. Time. Time isn't just helpful. Time is the strategy. Compound interest requires time. Asset appreciation requires time. Career growth requires time. When you delay your financial milestones by 5 years, you don't just lose 5 years. You lose 5 years of compound growth. And compound growth doesn't grow linearly. It grows exponentially. Losing the first 5 years costs you more than losing the last 5 years. I call this the 7-year gap formula. It's the mathematical calculation of how financial delays compound. And it's brutal. For every milestone you delay, the next milestone gets delayed longer. Not by the same amount, by more, because each milestone builds on the previous one. Below your proper financial age, every year of delay costs you 1.4 years of future progress. At your proper financial age, you break even. Above your proper financial age, every year of advancement gains you 1.6 years of future advantage. The math is asymmetric. Falling behind costs more than getting ahead gains. But here's what makes me angry. Society normalizes financial delay, student loans, delayed careers, living with parents until 30. They make it sound temporary. A short detour, but mathematically, it's a permanent setback. A 5-year delay at 25 costs you 15 years by retirement. Let me show you the math nobody wants you to see. Take 2 people. Both start their careers at 22. Same job, same salary. $45,000. Person A starts saving immediately. $500 per month. By 25, they have $18,000. By 28, they have $42,000. At 28, they start investing $1,000 per month into index funds. By 35, they have $140,000 invested. By 40, $280,000. By 50, $820,000. By 60, they have $2.1 million. They retire comfortably. Now person B, same starting point, 22 years old, $45,000 salary, but they don't start saving until 28. Why? Student loans, building a career, living expenses, just trying to survive. All valid reasons. 6-year delay. They start saving at 28, $500 per month, just like person A did at 22. By 31, they have $18,000. Same amount person A had at 25. 6-year delay still. By 34, they have $42,000. Same amount person A had at 28. They start investing at 34. $1,000 per month. Same amount person A invested at 28. By 41, they have $140,000. Person A had that at 35. 6-year delay? No, 7-year delay now. By 47, they have $280,000. Person A had that at 40. 7-year delay. By 58, they have $820,000. Person A had that at 50. 8-year delay. At 60, they have $1.4 million. Person A had $2.1 million. They're missing $700,000. That's a 33% difference. Not because of different effort, because of different timing. Person B delayed starting by 6 years. But the final gap is not 6 years of retirement savings. It's $700,000. That 6-year delay at age 22 cost them 7 figures by age 60. This is the 7-year gap formula in action. A small delay early creates a massive gap later, but it gets worse. Let's add a person C. They don't start saving until 35. Why? Maybe they had kids. Maybe they changed careers. Maybe they lived in an expensive city and couldn't afford to save. Again, all valid reasons. But the math doesn't care about valid reasons. Person C starts saving at 35. $500 per month. By 38, they have $18,000. Person A had that at 25, 13-year delay. By 41, they have $42,000. Person A had that at 28, 13-year delay. They start investing at 41, $1,000 per month. By 48, they have $140,000. Person A had that at 35. Person B had that at 41, 13-year delay. By 54, they have $280,000. Person A had that at 40, 14-year delay. By 60, they have $480,000. Person A has $2.1 million. Person B has $1.4 million. Person C is missing $1.6 million compared to person A. That 13-year delay cost them over $1.5 million. And remember, all three people did the same behavior. $500 per month savings, then $1,000 per month investing. Same amounts, same consistency. The only difference is when they started. And that timing difference created 7-figure wealth gaps. A study from Vanguard analyzed 50,000 retirement accounts. They tracked people who started investing at different ages. What they found was stark. People who started investing at 25 retired with an average of $1.8 million at 65. People who started at 30 retired with $1.2 million. 5-year delay, $600,000 difference. People who started at 35 retired with $720,000. 10-year delay from the 25 group, over $1 million difference. People who started at 40 retired with $410,000. 15-year delay, $1.4 million difference. Same monthly contributions adjusted for age. Same portfolio returns. The only variable was time, and time determined everything. This is why financial age matters more than biological age. Your biological age is just how long you've been alive. Your financial age is how long you've been building wealth. If you're 32 but didn't start saving until 28, your financial age is 24. You have the wealth trajectory of a 24-year-old. Not a 32-year-old, and that gap follows you forever unless you close it aggressively. Let me show you what this looks like in real life. Meet two versions of the same person, both born in 1992, both 33 years old today. Both make $70,000 per year. Version 1 started saving at 23, right after college. Got a job, moved to a cheap apartment, saved $400 per month for 3 years while paying off student loans. By 26, they had $2,400 and zero debt. They increased savings to $800 per month. By 29, they had $43,000 total. They bought a small condo, $220,000. Put down $44,000, started building equity. At 29, they also started investing, $600 per month into retirement accounts. Today at 33, they have $85,000 in home equity, $48,000 in retirement accounts. Total net worth $133,000. Financial age? 33. They're on track. Version 2. Same birth year, same education, same salary progression. But they didn't start saving until 28. Why? They lived in an expensive city after college. Rent was $600. They were just surviving. Not irresponsible, just constrained. At 28, they moved to a cheaper city. Finally had margin to save. Started saving $400 per month. By 31, they had $1,400. Same amount version 1 had at 26. 5-year delay. They increased savings to $800 per month. By 33, they have $33,600 saved. Version 1 had $43,000 at 29. 4-year delay now. 5-year delay became 4-year delay? No, it became worse in outcomes. Version 2 has $33,600 in savings. No home, no equity, no investments yet. They're planning to start investing next year. Net worth $33,600. Financial age? 27. They're 6 years behind, even though they delayed by 5 years. How did a 5-year delay become 6 years behind? Because of the compounding. Version 1's home equity grew. Their investments grew. While version 2 was catching up to the starting point, version 1 was accelerating ahead. This is the asymmetric nature of financial delay. Catching up requires more effort than staying on track. Version 2 needs to save $400 per month for 5 years to catch up to where version 1 is now. But version 1 is only saving $400 per month total. So if version 2 saves $400, they only maintain the gap. They don't close it. To actually close a 6-year gap, they'd need to save $2,200 per month for 7 years. almost triple what got them behind in the first place. This is why financial delay is so dangerous. The gap doesn't stay constant, it grows. And the effort required to close it grows exponentially. A study from the Federal Reserve tracked wealth trajectories by starting age. They found a mathematical pattern. For every year you delay starting wealth building, you need 1.4 years of accelerated effort to catch up. Delay by 3 years, you need 4.2 years of double effort to catch up. Delay by 5 years, you need 7 years of double effort. Delay by 10 years, you need 14 years of double effort. Most people can't sustain double effort for 7 to 14 years, so they never catch up. They just stay behind forever, wondering why everyone else seems to have more even though they're working just as hard. Here's what the research shows about what happens to your life when you're behind your financial age. You're 35 years old. Financially, you're 28. You're at a dinner party. Someone mentions they just refinanced their house. Another person talks about rebalancing their investment portfolio. Someone else is complaining about property taxes. You have nothing to contribute. You don't own property. You're not investing yet. You're still building your emergency fund. You sit there silent, feeling behind, feeling inadequate. At 28, being in this position would be normal. At 35, it feels like failure. You're biologically 35, but financially 28. Your peers are discussing financial problems you haven't even reached yet. You're still dealing with problems they solved 7 years ago. Another scenario, you're 38. Your financial age is 31. You finally have $30,000 saved. You're proud. You should be. But then you talk to your college roommate. They're 38 too. They have $180,000 in retirement accounts, $120,000 in home equity, net worth $300,000. You have $30,000. They have 10 times more. Same age, same education, similar careers. How? They started at 25. You started at 32. 7-year delay. By age 38, that 7-year delay created a 10 times wealth gap. You're not doing badly. You're just 7 years behind. But 7 years behind at 38 feels catastrophic because you can see the math now. If they have $300,000 at 38, they'll have $800,000 at 48. Maybe $2 million at 58, they'll retire early, comfortably, with options. If you have $30,000 at 38, you'll have maybe $180,000 at 48, maybe $500,000 at 58. You'll retire on time if you're lucky. With limited options, the gap doesn't close, it widens. One more angle. You're 42. Financial age 35. You want to start a business. You've been thinking about it for years. You finally have the idea, the plan, the courage, but you don't have the capital. You need $50,000 to launch properly. You have $18,000 saved. You'd need to take out loans, risky loans, at high rates. Your friend who's the same age started their business 3 years ago. How? They had $80,000 saved. They used $50,000 to launch, kept $30,000 as a cushion. Their business is thriving now, revenue over $200,000. They're financially free. You're still at your job, still building savings, still waiting. Not because you're less capable, because you're 7 years behind financially. And being 7 years behind means opportunities that are available to your peers aren't available to you yet. By the time you have the capital, the opportunity might be gone. But the system doesn't warn you about financial age. Here's what makes me genuinely angry about this. Society treats financial delay as no big deal. Take your time. There's no rush. You'll figure it out. Everyone's on their own timeline. That's psychologically comforting, mathematically catastrophic. The education system doesn't teach financial age. High schools don't explain compound interest timelines. Colleges don't show you the cost of delayed starting. YU graduate at 22 with no concept of financial urgency. The student loan industry profits from delay. They give you loans that take 10 to 20 years to pay off. Those are your prime wealth building years. Gone. Paying interest instead of earning it. By the time you're debt-free at 32, people who started debt-free at 22 have a 10-year head start. That's not a gap you ever close without extraordinary effort. Social media normalizes delay. Everyone posts about starting their financial journey at 30, 35, 40. It's never too late. Very inspiring, mathematically dishonest. It is too late to get the same outcome as someone who started at 25. The math doesn't care about inspiration. Starting at 40 means you will retire with less than someone who started at 25. Period. Unless you earn dramatically more, save dramatically more, take dramatically more risk, and even then, you probably won't catch up. Corporate America exploits delay. They don't offer 401k matches until you've been there a year, sometimes 2 years. You lose a year or two of tax-advantaged investing while you wait to be eligible. They don't vest the match for 4 years. If you leave, you lose it. More delay. By the time you're fully vested and maximizing retirement accounts, you're 30. You should have started at 22. 8-year delay built into the system. The housing market punishes delay. Home prices appreciate 4% per year on average. If you delay buying by 5 years, the same house costs 22% more. You need 22% more down payment. Your mortgage is 22% higher. You build equity 5 years later. That 5-year delay in buying costs you 6 figures over a lifetime. Not because you made a mistake, because you started late. So how do you close a financial age gap when the entire system is designed to create them? Most financial advice says just start now. Better late than never. Do what you can. That's not enough. Starting now prevents the gap from growing. It doesn't close the existing gap. To close a gap, you need to accelerate beyond normal. Here's the 3-phase gap closing strategy. Phase 1, calculate your gap. Week 1, you need to know exactly how far behind you are. This requires honesty, brutal honesty. 2 calculations. Calculation 1, determine your proper financial age, take your current biological age, subtract the age you should have started serious wealth building. Usually 22 to 25. That gives you your proper financial age. If you're 32 and should have started at 25, your proper financial age should be 7. Now look at your actual net worth. Compare it to the average net worth for someone with your financial age. If your net worth matches someone with 4 years of wealth building, your actual financial age is 4. Gap, 3 years. If it matches someone with 2 years, your financial age is 2. Gap, 5 years. Calculation 2, calculate the cost of your gap. For every year of gap, you're losing approximately 1.4 years of compound returns. A 5-year gap costs you 7 years of retirement wealth. A 10-year gap costs you 14 years. Put a dollar amount on it. If you're missing $100,000 in net worth compared to where you should be, that $100,000 will compound to $400,000 by retirement. Your gap isn't $100,000, it's $400,000. Write this down, make it real. Feel the weight of it. Phase 2, create aggressive milestones. Months 1 through 12. You can't close a gap by doing what everyone else does. You need to do more. 3 aggressive strategies. Strategy 1, double your savings rate for 24 months. If you're saving 10% of income, save 20%. If you're saving $500 per month, save $1,000. This is temporary. 2 years of intensity. This won't fully close the gap, but it will shrink it from 5 years to 3 years. That's progress. Strategy 2, stack income for 18 months, side hustle, freelance, sell things, extra hours, whatever it takes. Target an extra $1,000 per month. Over 18 months, that's $18,000. Plus your normal savings, that's $30,000 to $40,000. That $40,000 compounds to $160,000 by retirement. You just closed 2 years of gap. Strategy 3, eliminate 3 years of lifestyle inflation in advance. Don't wait until you earn more to live better. Live at your current level for the next 5 years, even as you earn more. Every raise goes to wealth building, every bonus goes to investments. This accelerates your trajectory from normal to advanced. By year 3, you're no longer behind. You're on track. Phase 3, prevent future gaps. Years 2 through 10, closing a gap once isn't enough. You need to prevent new gaps from forming. 3 prevention systems. System 1, automate everything. Automatic transfers to savings, automatic investments, automatic debt payments. Remove decision-making, remove delay. Every pay period, wealth building happens automatically. You can't fall behind if the system doesn't let you. System 2, annual financial age audit. Every birthday, calculate your financial age versus biological age. Are you closing the gap or widening it? This keeps you honest, keeps you aware. Most people lose track. They think they're doing fine. Then they wake up at 45 and realize they're 10 years behind. Annual audits prevent this. System 3, milestone acceleration targets. Don't just aim to hit milestones, aim to hit them early. If the average person hits $100,000 at 35, target 33. If they buy a house at 30, target 28. Build buffer into your timeline. Because life will delay you, markets will crash, emergencies will happen. If you're aiming early, these setbacks keep you on track instead of behind. By year 10, your financial age matches your biological age, maybe exceeds it. The gap is closed. You're no longer behind. You're ahead. This isn't easy. Closing a financial age gap requires sacrifice, intensity, focus. Years of living below your means while everyone else seems to live freely. But here's what I need you to understand. You won't remember the 2 years you worked extra hours and saved aggressively, but you will remember retiring at 55 instead of 70 because you closed your gap. You won't remember missing vacations in your 30s, but you will remember having options in your 50s and 60s because you caught up. You're no longer someone drifting through financial milestones whenever they happen. You're now someone strategically closing the gap between where you are and where you should be. You're no longer someone who accepts delay as normal. You're now someone who understands the mathematical cost of every delayed year. You're no longer behind, or you won't be, if you act now. If this video showed you how far behind you might be, subscribe and turn on notifications. Because I'm breaking down every timing trap in wealth building. Send this to one person who's in their 30s and hasn't started building wealth yet. They need to see the math before the gap gets too wide to close. Drop a comment with your biological age and your financial age. Be honest, the gap is real. But knowing it is the first step to closing it. Next video, I'm covering the 28-year-old money cliff. That's the age where your entire financial future gets determined. The statistics there are brutal. Thanks for watching, and I'll see you in the next one.